Hello, everyone. Today on the final bar, we'll do our normal Friday routine. We will wrap the week, focus on how the markets have evolved from last Friday to this Friday. If you're looking for a directional sense, it's net positive pretty much across the board. You have the cyclical areas, the value areas improving, defensives leading today at the end of the week. But overall, the market continuing to make new all-time highs and new all-time closing highs, punctuated by an acceleration to the upside. S&P 4468. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny but smoky Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market activity using the power of stock charts, using data visualization techniques, the tools of the technical indicators, technical analysis, and behavioral finance to quantify investor psychology and make better decisions, which is our ultimate goal. This week certainly about strength. I mentioned it's smoky here. We've got the wildfires in the Pacific Northwest, which are certainly presenting some air quality challenges and plenty of challenges for people. So I hope everyone is able to stay safe. The markets themselves continuing to push onward and ever upward. I'm going to butcher Greg Morris's quote. Greg Morris is a longtime contributor to stock charts and a legendary technical analyst. Basically said new highs are usually bullish. It's just the last one that isn't, or something along those lines. Or it's usually a good thing, except the last one. And what that means is when the market continues to push higher and higher, that's all good. Higher highs are good, but the very last one is the one where you buy into the new high and then you're disappointed as the price goes lower. We've been looking for signs of that coming. We really haven't seen it materialize. We'll continue our ever watchful gaze on the market, continue to push higher. We had great guests this week. Had a lot of fun with Matt Tuttle yesterday talking about risk management and just overall thinking about this sort of environment and others. Next week on Tuesday, the 17th, Sean McLaughlin from All-Star Charts. He's the options strategist there. On Wednesday, the 18th, Jay Soloff from Investors Alley. On Thursday, the 19th, Larry Berman from ETF Capital Management in Toronto. Then coming up the week after that, on Tuesday, the 24th, we have Kathy Donnelly, author of The Life Cycle Trade. Also, my next webcast will be this coming Tuesday, the 17th, 1 p.m. Eastern, focused on relative strength investing. I was often told that to win the baseball game, you want to have your best players on the field. You would not put your worst players on the field if you want to beat the other team. That is what we should be thinking about in terms of our portfolios, our positioning, and that is the essence of momentum investing, leaning into what's working and leaning away from what's not. We'll review some of the best practices of that and focus on some of the stocks showing strength today. If you're interested in that free event, go to marketmisbehavior.com/relative strength. Let's continue on with today's Wrap the Week segment. This is our really way of recapping the market activity through the course of the week. Couple steps to this. We're going to start actually with a poll, and then we'll get to some of the charts that tell the story of this week. Recent poll, we asked you the 4 top performing S&P sectors year to date through the beginning of August were energy, real estate, financials, and communication services. Which of those performs best through year end 2021? The majority answered, 55%. Financials followed sort of a two-way tie between communications and energy, and then REITs sort of the laggard with only 8%. So two things that strike me about this. Number one, financials. And when I was talking to my guests, the last 2 days, Matt Tuttle on Thursday and then Samantha Leduc on Wednesday, both talking about interest rates, the rising rate environment, inflation concerns, but also the emergence of the financial sector. Really, if rates are going higher, really speaks to the strength of the cyclicals and especially the financial sector. So interesting that 55% of you picked up on that same theme that I was talking about with some of my guests there. I'm always drawn to what got the least attention because I think that usually provides a bit of a contrarian opportunity. So none of us, or 8% of us, that's not true. Only 8% of us picked the real estate sector. When I'm looking at sectors Real estate's not too bad. REITs are actually outperforming pretty well. The relative strength has tapered off. I mean, most of their gains really came in the first, 6 months of the year. June and July have been relatively flat, but it's still holding in with the markets. My thought is if the market turns defensive, which it certainly has not been doing a whole lot of, but real estates have been outperforming when the market was in go mode and could certainly re-exert itself and go higher. I'm interested going to our Wrap the Week segment here, how real estate was number 2 today. The top 3 sectors in a day when the S&P made a new all-time closing high were consumer staples, real estate, and utilities, right? And it's interesting how these sectors sort of push higher at a time when you wouldn't expect. I often tell people, don't think about what should work. I think one of the worst mistakes you can make is I'm bullish on the market, so I should own these sectors, or I'm bearish on the market, so I should not own these types of names. You're shortchanging the value of technical analysis and trend following to illustrate what actually is working. The reasons why utilities or real estate do well in an up year is something that becomes clear way later. At the time, I would focus on what's working. And again, some of the defensive stuff really working today, which is worth paying attention to. Just very quickly, a brief update on what happened today. Then we're going to look at the Wrap the Week chart, which focuses on weekly returns. Then we'll spend the rest of our time with the Mindful Investor Live chart list. The S&P today, as I mentioned, a new all-time high to finish the week strong, accelerating into the close, 4468 or so. Mid caps and small caps underperforming, with the small cap index really, pushing to the downside. Let's talk about a tale of two markets. The S&P pushing a little bit higher, again, not a ton, only 0.2%, but the small cap index going lower. Now, this is all the financials, industrials, energy, which is a little higher weight in the small cap index, pushing lower. The VIX pushing ever lower, below 16, around 1530. Interest rates actually down today, and so the 10-year yield actually came off, with the 10-year yield finishing the day around 130, and bond prices actually bouncing higher. We'll see if we have time to look at a chart of interest rates. Probably have to wait till Monday to spend enough time digging into that. Dollar weaker as well by about 0.5% on the UUP. Gold and precious metals actually working. Gold has been a tough chart, struggling recently, but you see the GLD popping higher along with silver. The rest of the commodity complex actually down today, with energy the weakest of the S&P 11 sectors. Bitcoin accelerating to the upside. We've had some choppiness after breaking above 42,000, but most cryptocurrencies in the green today, accelerating that move back to the upside. And again, when I think about charts and just very quickly decide, is it risk off or risk on? It's hard to look at the average cryptocurrency and think it's anything but risk on right now. I think Bitcoin breaking above 42,000 and remaining above that level is very important. Yesterday, you had the rotation back down to around 44,000, but really pushing back to the upside and bouncing higher here around the close, New York time. Let's continue on looking at our Wrap the Week charts. This is where we focus on the major asset classes and how they've evolved from last Friday. So we start the clock at last Friday's close. We go to where we're at today. What's interesting today is that the S&P is actually one of the best out of all of the bunch. The S&P was one of the leading asset classes when we look at the major ETFs we'll review here. Only a couple things outperformed, but most things were actually underperforming large cap stocks this week. The S&P finished the week about 0.8% higher. That's the line in black here. I'll quickly indicate the other lines in order. In red, we have bond prices using the TLT up about 0.5%. In pink, we have the NASDAQ 100 up 0.2%. Everything else was down on the week. We had, or that we'll get to here, crude oil and the US dollar both down around 0.3%. In orange, we have emerging markets down 0.4%. And the chart of emerging markets relative to developed markets, by the way, is incredibly negative, favoring developed over emerging. Emerging's really been underperforming pretty significantly for quite a while now. And then the worst performer of the group, small cap stocks, down 1%. Now, small caps still overall have had a pretty decent 2021, but it's been the last couple months where you've seen the deterioration in small cap performance. A bit of a bounce earlier this week when you saw the reemergence of the cyclical trade, the infrastructure bill, et cetera, sort of providing some upside, but really coming back off here at the end of the week. Gold, the lone asset class outperforming, but we are not looking at cryptocurrencies yet. I'll throw that in a minute. And Bitcoin's certainly the best of the bunch, but the GLD up 1%. That chart of gold, again, has been a challenging chart. It was sort of testing the moving averages, all rolled over. And then you're seeing it bounce back to the upside with, after Monday selling off, the rest of the week was actually fairly constructive for the chart of gold. Now, if we add Bitcoin into the mix, you can see that it's by far the outlier. Everything else we just talked about is down here, and you can see that the Bitcoin index that we track, the spot price essentially of Bitcoin, up about 11% for the week. So it's interesting how you've seen a rotation higher. The chart of Bitcoin will go there here very quickly, and then we'll see if we can hit on gold, and then we'll go to some of the other charts. The chart of Bitcoin really has been range bound from 30 to 42,000. Breaking out of that range, I think, is significant. Key levels in my mind, looking at this chart, 44,000 is really a Fibonacci level. If you take the September low from last year, which is when Bitcoin's at 10,000, you take the high around 65,000. 38.2% of the way down is the 44,000 level, which is where we bounced this week as we accelerated and went back to new highs. So I think that 44 to 42,000 level, which is this shaded area here, I think is crucial. That was the most recent test here in July before we pulled back. So I think as long as we remain above that range, Bitcoin is in pretty good, it's a pretty good uptrend. Everything else about that chart indicates more risk on than risk off to me. I see the chart is fairly constructive. Gold, on the other hand, has been a little more challenging. Looking at a chart of the GLD here, we've seen this bounce off of the lows. The GLD became oversold, undercut the lows from June, which I thought was a fairly negative pattern, now bouncing a bit. And I think going into next week, it's going to be a range-bound sort of pattern from the lower end of where we've been to the upper end. But undeniably, it's making a pattern of lower highs and lower lows. And a higher low would be the key indication next week or beyond that would tell me gold is starting to stabilize. But at this point, if there is a trade that is long Bitcoin and short gold, it's been a fairly decent trade this week and really in the last couple of weeks to the last month. Let's continue on this segment looking at the Mindful Investor Live chart list. As a reminder, if you've not watched our show on Friday before this year, these are all available to you as a StockCharts member. Go to the articles tab, go to my homepage called the Mindful Investor. You can get to this list of charts called the Mindful Investor Live chart list. There's a link right at the top of my blog that has a link to this page. We'll start with the market trend model. This is a model that I've been running for years, and it's based on weekly data and exponential moving averages derived from those weekly price points. And essentially, the long-term model has been positive since early June of 2020. That remains very, very strong. The short-term model has been bullish, say, for about 3 or 4 weeks over the last 8 months. It has remained bullish pretty much every week, and that's simply looking at where we are at relative to the 5-week exponential moving average. The medium-term model, for me, medium-term trend model has been negative since May. It's threatened to turn back positive a number of times, and it is so close. And I was sending a note out to my own clients earlier today, and what I mentioned was, I designed this model to be binary. I try to take some of the wiggle room out, and so it's either bullish or bearish. There's no middle point. There's no neutral rating. It's either a thumbs up or thumbs down, and that was meant for simplicity and looking at a bunch of different asset classes and making a quick assessment about what was working and what was not, and the neutral rating sort of clouded the issue, I thought. However, if I did have a neutral rating, it most likely would have been neutral for the last month or so, because we're so close to the zero level, right? It's sort of right around that point that it really could be either way. The fact that it turned negative in May for me is more illustrating that stealth correction that we've talked about, where a lot of stocks have been pulling back. This is when all the cyclicals really started to struggle. You had a lot of leadership rotation. So I don't have a problem necessarily with the fact that it's been relatively risk off for that stretch. The daily chart looks less and less threatening. You had this foreboding pattern of breadth non-confirmation. You had the bearish momentum divergence in July, similar to what we saw in April, similar to what we saw in January. Both of those previous momentum divergences led to about a 4 to 5% pullback in stocks, pulling the S&P back to the 50-day moving average. What we have not seen is anything like that. We had a minimal pullback here in early August, but nothing like what I would normally expect given the divergence that we've had. Now, what's surprising is those were in relatively strong parts of the equity calendar. Here, we're getting a bearish signal in the middle of the weakest part of the year, July into August into September. So we are not out of the woods seasonally, but I tell you, the trend continues to go higher. I see so many reasons why the market should go down, but the one thing the market is not doing is going down. I do want to point out, we talked, I believe, on the show about the DeMark sequential, which is a trend exhaustion technique that I'm very familiar with. I actually registered a sell signal last Friday, which on the surface tells you we should be reverting lower, but there's a built-in signal in there where you need what's called a price flip, which is a close lower than the close 4 days ago that we have not had all week. So it didn't really validate that sell signal. I know it was on the Kramer show, and I heard some buzz about it on social media. You really might have to wait for a price flip. So going into next week, that's what I would be looking for if that does happen. I think that would validate that sell signal, which is still active. The breadth overall, still not overwhelmingly positive, but not as negative. I hesitated. I almost turned these color-coded more orange neutral color, the advanced decline line for the NYSE and for the small cap index. I did not do that. I kind of left them red, but I think it's a subjective call. It could be either or here. Probably could call them negative and feel okay about that. The reality is, though, they still have not confirmed the most recent high. So I would say to give an all clear to this market and showing a resumption of internal strength would be a close above or a move above the June highs for those cumulative advanced decline lines. We've not seen that yet, although they certainly have stopped going lower. We're seeing a handful of new lows on the New York Stock Exchange, a handful of lows on the S&P 500, but still very, very few. The challenge with that is obviously the 52-week low for most stocks is really far away from where we're at. So it's tough to indicate that as being a great indication. Maybe looking at 3-month lows or something could be a better indication. I screened Wednesday for stocks making new swing highs and new swing lows using a 3-month time period. I found 66 stocks in my large cap universe, about above 10 billion or so. So that's really a mid to large cap universe. I found 66 names making new highs, 31 names making new lows. That's about a 2-to-1 ratio, which is about average. Earlier in this uptrend, it had been much more skewed. It was difficult. Very few stocks making new swing lows. We're seeing an increasing number, but still not crazy. And the last chart we'll leave it with is this one, the percent of stocks above their 50-day moving average. It's not horribly negative, right? This was at 92% in April. It was at 32% here in mid-June. It's back up to 69%. That's not updated for today just yet, but overall, that's a pretty strong number. That's actually middle of the road for the uptrends that we've been in for the last year and a half or so. So that real negative divergence, we have the stocks, the index going higher, but so many stocks below their 50 days started to change as so many of the cyclical sectors have started to improve. So we're seeing the breadth conditions actually get less negative, if not starting to be supportive of this uptrend. We need to take a quick break. We'll be back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we break down the market activity, the themes of the day, the themes of the long-term trends and how they're evolving every weekday. A couple quick announcements before we get to our mailbag segment. We'd love to hear from you, particularly questions that come up as you are analyzing your own charts, things you're reading or seeing elsewhere, watching elsewhere, charts that you're analyzing in your own portfolio, ratios, whatever it is, technical indicators. Let us know how we can help. You can get your questions to us 3 ways: via email, thefinalbar@stockcharts.com, via Twitter @finalbarsctv, via YouTube. Just put a comment below the video that you're watching. We'd love to hear from you. Hope to answer one of your questions in our next mailbag segment early next week. Also, go to stockchartstv.com, put in your email address. You can start accessing all of our fantastic content from the website, also from your mobile devices. Great guests like we had this week with Matt Tuttle and Samantha Leduc and many others. Fantastic special events like Charting the Second Half, our mid-year market outlook, and all the great shows like The Final Bar and Your Daily Five and many, many others. Go to stockchartstv.com or just search on your app store on your mobile device for StockCharts TV on demand. Let's continue on with our mailbag segment, the Final Bar Mailbag. Again, send your questions to us via email anytime, thefinalbar@stockcharts.com. Here we go. Hi, David. Regarding Chaikin Money Flow, please see UNP Union Pacific on a daily versus weekly basis, and you get 2 different stories. Why? Fantastic question. Let's bring up the 2 of them. So we had Mark Chaikin on the show. What was that, last week? I believe so. I had again, a very brief discussion. We talked about a number of things, really talked more about his Chaikin power gauge, but a couple of the indicators that he has pioneered, the accumulation distribution indicator and also Chaikin money flow, which is a great way of, again, the theory is tracking money and how it's flowing between different, in or out of a particular asset. And we'll get to the calculations of it because I think that'll help answer your question. So this is the daily chart of UNP, and you can see at the bottom, we're looking at 2 years, and you can see the Chaikin money flow as a histogram above or below the zero line. We're looking at the same time period now on a weekly chart, and you can notice instead of being fluctuating around the zero, being positive or negative, it's just net positive the whole time, right? So how can that be where the same stock is giving dramatic different indications? So here's the thing, and I will tell you, I'll give you the brief, only enough time for the mailbag sort of answer, and I'll point you where you can find more information on it, which is on our chart school pages. But it gets to how the indicators actually calculate. The Chaikin money flow is basically looking at where we are trading, where we are closing today versus the high and the low over a particular period, right? So if you're looking at the daily Chaikin money flow, looks at the daily close versus the daily high and the daily low, where are we at within that range? And basically, it's a way of measuring the volume because the daily volume read is multiplied by that ratio, basically by that fraction, which shows you where we're at relative to the high and the low. So the higher we are at the upper end of the range, the more today's volume is added to this running total. If it's negative money flow, it's subtracted from that total, and that's how the Chaikin money flow gives you the overall percent of where we're at, versus the range there. Which means if you're using daily data in a choppy market, when a stock is fluctuating around, you're going to get a lot of swings in the Chaikin money flow because it's all about the volume versus where we're at over that period. It smooths out that reading so you can get a proper ratio that shows it. On the weekly indicator, you're taking the entire week's volume and you're taking it based on where Friday's close was relative to the highest high and the lowest low over that entire week. So basically, if a stock would tend to finish the week more on the upper end, the Chaikin money flow based on weekly data is going to tend to be more positive because of that. And that's what I would suggest is happening. You basically have a lot of positive weeks, and as a result, the money flow overall is going to be net positive. Based on the calculation of the indicator and what Mark Chaikin was actually trying to accomplish, I don't put a lot of weight on the weekly money flow because what you're assuming there is that the Friday close is really meaningful for the week. And I don't think that's the case. I think a lot of things can happen during the week. I think this is one of the glitches, or not a glitch, but it's just based on the design of indicators. I think it treats Friday's close a little more meaningfully than it needs to be. So on daily data, I think is a much better reading because what it's doing is tracking the daily change in volume or the daily volume based on the change in price and where the day plays out. So what is a better measure of money in and out of the stock? I think the daily Chaikin money flow is a much better gauge of that. Why the two are different is on the calculation. And if you have a situation where the stock is closing at the highs or you have heavier volume, it's taking all of that positive and negative volume and attributing it basically based on Friday's close versus the range of the week, which I don't think is a great way of thinking of it. If you want to learn more about that and answer a little more detail in terms of why it is playing out that way, go to the chart school, which is the link, one of the links at the top of the page. Search for Chaikin money flow. You can get a lot more detail on the formulas and how they're calculated. Next question, just curious, you seem to favor bar charts over candle charts. Any reason the final candlestick doesn't have the same ring to it? I love that question so much, and thanks for that. So it really is a preference thing in a lot of ways. And there have been times in my career where I've looked a lot more at bar charts versus candle charts. And I'll dial in the range a little bit and I'll show candlesticks, maybe like a 6-month chart. When I learn technical analysis, I use candle charts all the time. And I will tell you, a bar chart or candle chart really tells you the same information. It's open, high, low, and close. And it's just how it's representing it visually. Bar charts, it's a little difficult if you zoom out to understand the trends. And my time at Fidelity taught me it was much more about the larger trend. It was a lot less about the daily movements because we were longer term investors. So using bar charts, sort of gave the appropriate weight to the trend over the daily price action. If I was a shorter term trader, if I was a swing trader, if I was trading currencies and looking at a couple days or less, I would absolutely be using candle charts. And you'll see I occasionally refer to them, but more often than not, as a long-term investor, the daily candles I don't think add as much as they could. Now, there's a whole methodology to using candlestick analysis. If you read books by Steve Nissen or others, do a great job of explaining the methodology. And I've had a chance to talk with guys like Steve and a lot of traders and money managers in Japan or at Japanese banks, and I there is a whole methodology using candles and using the names for the patterns. And I don't want to minimize that because I think they're incredibly interesting. There are certain candle patterns that I find really helpful, which we tend to focus on. So when I talk about bearish engulfing patterns, which we see here on Health Peak, what it basically tells you is an up day and a down day where the second day engulfs the first tends to be a distributive pattern. I think things like that are really fascinating. I tend to pick those out on the bar chart without looking at the candles. But as you're learning, I think candle charts are fantastic. So the short answer is it is a preference thing. And bar charts for me help focus on the long-term trend, which is where I'm trying to focus my energy. Last question, then we have to wrap. As you said, the S&P 500 pulled back 6 times to the 50-day moving average this year. Looking at a chart, it appears the chart has made correction in a cyclical fashion. Can we describe the cyclicity, which I don't know if that's a word, but maybe cyclical nature of the S&P chart and coming correction? Does the VIX talk about looming correction? Really, really good question. We talked about the VIX in yesterday's show, and I think, the VIX being below 16 and really below 20 has been a real change. I think that's interesting. For me, the problem is the VIX is not defined by a particular range. It's not like RSI where you can say it's oversold. You can see where it's at, and it's at the lowest levels that it's been this year. I think that's an interesting data point. But thinking about the cyclical nature, you're right. It's about once a month or so. If you take April out of the picture, pretty much every month, about mid-month, we've been pulling back. But I think that is more coincidental. I don't know if that's necessarily a cycle that you could bet on. There's no natural month-long cycle, I think, that plays out in stocks. What I think we're picking up on, which absolutely does make sense, is the short-term. In the short term, the market is mean reverting, which means you have a longer term trend and you have the short term peaks and valleys within the trend. And in general, sort of a couple days to a couple weeks is a mean reverting pattern, meaning in general, you're better off selling strength in that period and buying weakness. And what the S&P chart in 2021 shows you is a perfect example of how that works. The medium-term trend, sort of a couple months to a couple years, is very much positive with the S&P. The short-term trend is mean reverting as it normally does, which means if you're at the lower end of that range down to the 50-day, it's a great opportunity to buy or add to longs. We're at the upper end. If you draw a regression channel, look at the upper ends, which are some of the places where you've been shown those bearish divergences. It tells you we're probably going to mean revert back down to the midpoint. And that's been a very decent strategy. And again, that works until it doesn't. And that's the challenge with any sort of cyclical attribution to what I'm seeing with price movements. That pattern is an interesting pattern until it breaks. And so again, as a trend follower, I'm seeing stocks moving higher, and that's the underlying trend. Great questions, everyone, and thank you so much for sending those in. We need to wrap the show and go to the 3 and 3. 3 charts in 3 minutes. Here we go. Chart number 1 is the Dow Transports. Transports are going higher. We talked about this Dow theory non-confirmation, which really came out in June into July, where you have the Dow Industrials making new all-time highs, which it has been doing. The Dow Transports not doing so. And that was Charles Dow's original concept of using the industrials and the railroads as a way of quantifying the producers of goods and the distributors of goods. And are those two main parts of the economy working together or not? And when you have disagreement, that tells you there's a problem. We had that disagreement with the Dow Industrials versus the Dow Transports. And while the transports are not a bullish chart necessarily yet, it certainly stopped going lower. We have a short-term low in place. We've made a bit of a higher low, at the very least a double bottom, and we're back above the 50-day moving average for the first time since June. We're having RSI just below 60. I think that's a key chart to watch going into next week as we gauge this potential for the market to just get out of the stealth correction without a major price correction. This is one of the charts I think that could help us make that assessment. Chart number 2 is the FANG Plus Index, which is $NY FANG. On StockCharts, you can see that we have a double top of sorts. We have a resistance level from February, once again in early July. We tested that a couple times, had these great what we would call a shooting star candle. I had to throw a candle pattern in there just to demonstrate that I use them. But overall, it's come off there. We haven't made a new high. Charts like Apple are starting to fail a little bit. They're not able to break out. Charts like Amazon, which broke out, failed in the breakout and actually came back into the price range. So the FANG index is not really the juice right now. The market is going higher despite the FANG stocks, not because of them, which is a change from what we saw in May, June into July. This is another potential leadership rotation with the cyclicals taking over leading into the end of the year, which I suspect is what we're going to see. The final chart for the 3 and 3 is Apple. We've talked about this chart before, a pennant pattern, trying to break out, but did not really follow through today. I think going into next week, that is one more chart to follow. This breaks out of this pattern to the upside, it's hard for me going to be thinking about much negative trend for the S&P because Apple's breaking out. The market itself is going to hang out there just fine. If, however, next week that fails, we go to the lower end and break lower. That could be very, very negative. Folks, that is our show and a wrap for this week. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great weekend. We'll see you on Monday. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.